Welcome back to Business Week here on Arise News. I'm joined now by Arnold, Dublin-Green, MD and CEO of RC Asset Management Limited, to help us review some of our top stories in more detail. Good morning, Arnold. Great to have you on the show.
Thanks for having me.
So, oil prices. Let's start with crude oil jumping.
Yes.
I mean, the figure we had was 8%, but that 8% is now redundant because now we're now at $92 a barrel. So. Yeah. You know, some sides say it's just geopolitical risk spike. Is this a longer-term trend that will then be brought on by this issue? Yeah. So what's your take?
Okay, well, I think we can start from the beginning last Sunday when the war broke out, right? We all thought geopolitical risk. We saw oil go from 70s to 80s. No one saw a disruption in operations, right? Because the Strait of Hormuz, of which about 26% of the world maritime oil goes through, accounts for, it'll cause a crazy spike in oil, which is bad for US elections. 40% of China's imported oil comes from the Strait of Hormuz. And it will also disrupt Iranian revenue generation, which is bad for the current Iranian administration. So no one actually thought there'll be any disruption from this supply. But as of Thursday, we've seen around 1.5 million barrels per day come off the markets, right? And if you kind of do rough straight line maths, you can assume that by now maybe another 2 to 4 million barrels per day will be off the market.
Yeah.
So now what it means is oil spikes more, right? So we could probably see a $100
so you're predicting potentially over 100 by next week?
Yeah, and the thing is, where's the price, right? It could be 150 in a few months, it could be 200 in a few months, but if there's no intervention, if there's no slowdown in anything, if everything remains the same, then $100.
And you know what's really interesting is the quality of Iranian crude, which is really one of the lightest and the sweetest, the ones that are really in demand by refineries, the more expensive heavy grades. You know, you need a lot more financing to sort of get them through refineries. So it's really interesting. But compared to previous oil spikes, you know, this one combines the disruption in the Strait of Hormuz. But we're also seeing attacks on things like infrastructure, data infrastructure. I mean, how does this even feed into concerns by policymakers around the world around inflation?
So it's a hard one, right? And I've spoken to a few clients this week, right? So my job is to figure out how to either make money for my clients or protect client assets. But a spike like this in a short to medium term is massively inflationary. You see the demand for oil is inelastic, which generally means that people will still buy even though the price goes up. And now, for me, it's how does it affect asset prices? We're seeing it in US Treasuries, 2-year and 10-year yields are spiking. But you're also seeing a rush for cash or near-term cash instruments. That's why you're seeing the dollar rise, which is negative for emerging market currencies, especially emerging market countries that don't have their act together, you know, double deficits, swing deficits. You're seeing the Turkish lira weaken, you're seeing the South African rand weaken. I'd like to think that policymakers, maybe, I'm not sure what their role might be, but they're going to have to find ways to protect the currency because everyone's now worried about global inflation and inflation coming into their countries.
Yeah, just when we thought we were reaching that point of maybe starting to really see an easing trend, right?
Yeah, it's getting tougher again.
Indeed. So Uganda has now embarked on this gold buying program, right? So I'm thinking here's a country that's sort of taken advantage of this rush to gold. It's going to be converting shillings to gold reserves. Instead of maybe focusing on earning currency through exports. Like, what's even the strategy here? Is it just an opportunistic move?
Yeah, so they've been talking about this for 2 years, right? And they decided to start this month. It is opportunistic in a sense. Well, just to go back, they've been exporting gold, right? They exported about $5 billion of gold last year, which is up about 74% year on year from 2024 to 2025. But yes, it's part of the global de-dollarization. So you're seeing this global shift of central banks around the world.
Yeah, it's in China, Russia, Turkey,
everyone. Uzbekistan has about 80% of their reserves in gold. Italy has 79% and so on and so forth. So I think it's actually a positive move. And also something to note is the central bank is buying local gold. So you're boosting local production. Right. So where you can export some, you can also sell some to the central bank. So it's positive in my view.
Yeah, and so clearly it's going to boost their external position. But in terms of really how we're likely to see that strategy spill over into what other African governments are doing.
Yeah.
Is this going to be a sort of broader push towards de-dollarization across the board?
I think so. And I think every African country should be doing this.
Yeah. Not just gold producers.
Not just gold producers, but everyone should be doing it, because we are seeing, especially with everything going on, okay, right now, yes, the dollar's getting stronger, but this is a knee-jerk near-term cash reaction. Gold will still appear to be or come out as the best safe haven, also a good inflationary hedge as well.
Yeah. So let's talk about Ghana. I mean, it's incredible looking at, we're now at 3%.
We are at 3%.
We were at 50-something percent just like a year ago. That is such a dramatic fall. So how much of this is actually because of true structural reform, as opposed to Ghana perhaps benefiting from other types of externalities, such as we're seeing gold prices obviously rise? Help us understand what they've actually really done to transform that trend.
So yes, gold has helped massively, right? They pushed reserves up to about 40% of it with gold, and they sold about 20 tons or so over the past month. But the IMF, they defaulted a few years ago.
Yes, they did, and they've been restructuring.
They had to really tighten buckle down and tighten. So the IMF structural reforms really, really helped. And that also helped with market confidence and investor confidence with inflows coming in. So yes, gold has helped them massively. Ghana is a huge gold producer. They're exporting a lot of gold. The central bank also started a heavy gold buying program. They haven't really taken advantage of cocoa as much as I expected them to.
Right.
But the structural reforms that they put in place, the policy reforms, the FX reforms, and also you could actually see the debt default as a reset that needed to happen, even though when it happened, nobody was happy about it, and we all thought they would be cancelled out of the market. But 2 to 3 years down the line now, we expect Ghana's bond issuance to come online this year, or at least by 2027.
Yeah, interesting. So, okay, we're expecting a 5th rate cut in Ghana.
Yeah.
But here's the thing. Globally, all prices are rising.
Yeah.
There's a risk of imported inflation. Could those trends derail this trajectory that Ghana has embarked on?
Yeah, it could.
What's your thought?
It could. So, like I said, talking about when I spoke on a global macro level, talked about a strengthening dollar. Dollar strengthening quickly. This affects, because now one of the reasons why Ghana's inflation went down to 3.3% is because of a strengthening CD or a stable CD. With this global geopolitical risk coming in, it could mess plans up a little bit.
Yeah, because they will need to defend the CD if prices start to rise, but you're trying to support growth by cutting rates, right?
Exactly. So, and it could send the wrong signal to the markets as well, send the wrong signal to global investors. So
interesting times. It's interesting how all these topics we're discussing, there's a huge externality, which is these oil prices rising. Yeah. And depending on whether you're a net exporter or importer, producer of commodities, the outcome could be very different. Nigeria's net FX reserves 772% in 2 years. Why is that such a big deal?
It's wonderful, and I think we all have to doff our hats to the central bank with all the policies that it puts in place. I think it's what's even more interesting is it helps with the geopolitical shocks that we're seeing, right? First of all, kudos to the central bank and the central bank governor and the team. All the policies had to go in place. They had to cut down short-term liabilities and figure out how to increase FX reserves with everything going on and all the reforms, and that's happened. But now it's a good time for it to happen because, we might end up seeing shocks. We might end up feeling shocks from what's going on around the world, and having external reserves at 34 billion is a great cushion for us.
But so there's a $15 billion gap because gross reserves are like 54.
50, yeah.
So there's some liabilities there.
Yes.
Is the central bank still doing swaps and contracts and things like that, which suggests that maybe FX pressure could ultimately become a thing, right?
Yes. So yes, they are not as much as they used to be, right? And that's why it's better on a net on net basis. But still, the number is still comforting, right? 34 billion is still comforting. I think that we should be able to weather some of the shocks that we're seeing in the short to medium term for the rest of the year.
So, assuming we go up to $100 a barrel. And suddenly things de-escalate and that $100 a barrel unwinds. Does this reserves... I know much of the reserves building has also not just been from high oil prices. It's been from sort of specific things they've done.
Yeah.
But could we then be creating a false sense of security because here we are, reserves probably go up more as oil prices go up. Nigeria exporting oil, we're getting more dollars in, we're building those reserves. This geopolitical environment suddenly de-escalates, everything goes back to normal. The market is structurally oversupplied from an oil perspective. All those positions unwind. Is there a risk that that could become a bubble that bursts?
Yeah, so there is definitely, right? Because one of the reasons the external reserves is where it is a lot of FPIs coming in, foreign portfolio investors. And we know foreign portfolio investors, we see them as hot money. The exit, if there's a quick exit to this, the shock in the system could be something to be worried about. My hope is that we are able to still keep them in, whether it's through increasing our rates of treasury bills, rates of return on treasury bills, and also the central bank going back into OMO issuances like it did last year at a rate that is helpful for them and also positive for
okay,
for
well, I
investors.
like the sort of fairly positive tone you're taking around this. Let's talk about Nigeria's GDP, 4.07%. It's the first time I've seen that come into any GDP figures in quite a few years. So, I mean, that's a great thing. Tell us about what the rest of the year is likely to look like.
So I like it. I mean, there are components that I don't like, and I'll talk about it in a minute. But agri and services is wonderful. That's the big contribution. So I think that carries on through the rest of the year. My worry is manufacturing, right? I think that a country needs manufacturing to get to the next level. We saw manufacturing contribution go from 8.2% in 2024 to 8.05% in 2025. So it's negative. It's going down. I was happy going into a low inflationary environment, expecting the central bank to reduce MPR because this will help credit growth, because the manufacturing industry needs credit growth. If we continue to see MPR stay where it is today or continue to get slightly lower, although this geopolitical madness changes it a little bit, but if we continue to see MPR go down, we should see some credit growth that will help manufacturing. So hopefully actually running through the year, the manufacturing contributions to GDP should increase, and then this should hopefully increase.
And it's interesting because until the last sort of cycle of MPR decisions, it seemed like we were bucking a bit of a trend, because where you have a bit of tightening from a monetary policy stance, it someone stifles growth. But we still managed to come from a period of tightening or holding in terms of rates, and growth has still sort of gone upwards. So we seem to be bucking a trend. Does this suggest that maybe our economy is structurally more resilient than we care to imagine?
Yes, definitely. It definitely does. I mean, and inflation is going down, right? So it's helped the central bank ease MPR, perhaps not as aggressive as we all want, but in a nice stable rate, which I think they're doing a good job.
And maybe the not as aggressive as we want is probably a good thing in light of what's happening globally. A more cautious stance. But it's, as always, really great chatting to you. We didn't really get to really delve deep into the gold today, but we touched on it. It had to creep in there with Ghana and Uganda. But thanks a lot, Arnold, Dublin-Green. Thanks for coming on the show.